Hey, good evening. This is Mayor Valensky with Driving Markets YouTube channel. Remember that on the channel I'm looking for more subscribers and comments. So anyone who wants to subscribe, you can subscribe on YouTube, Twitter. I've got an Instagram channel also that I do reels on and pass comments. And also you can share it with your friends. Okay, so today I want to do a little bit of an education piece. So I'm not in my car, as you're well aware. And what I'm going to do is I'm going to try and give highlighting a little bit of education regarding liquidity. I've been asked by several viewers and several followers and subscribers on Instagram and on YouTube, can you explain exactly what the liquidity issue is surrounding the Bitcoin and the cryptocurrencies? So liquidity is a topic in itself. It's a headline, liquidity. So liquidity means how much liquid, how much cash, how much available funds do you have in your account. That liquidity could apply anywhere to simple bank account, whether you have money on deposit or whether you have an overdraft or whether you have a mortgage or you have investments. And as there is more money in your bank account, obviously you have more liquidity, which means you have the ability and the power to purchase, spend, save, etc., etc. Sometimes on a very, very basic case, very simple, strip it down to the basic level. Let's say an individual has an overdraft with a bank and they might be going through a 2 or 3 months or 6 months tightness regarding their particular cash flow. So what do? They go to the bank and they ask for an extension of their overdraft or an increase in their overdraft, and that will give them liquidity provision. That will give them enough substance and defensive and enough resources in order to get through that particular tight period. So when talking about liquidity in the crypto market or in finance, let's focus a little bit on the crypto market at the moment, and then we'll move on to equity markets, how liquidity has impacted them. So the big news this week was regarding FTX. Now FTX is was the second biggest crypto exchange platform. That was run by a guy called Sam Bankman-Fried, who's 30 years old, valued at around about $26 billion at one stage. He personally was valued at around about that, simply because he was very heavy for the last few years, or last many years, involved in digital currencies. And the digital currencies, as you're well aware, has expanded to such a degree over the last few years where anyone that was involved in the early stages of the crypto industry, crypto sector, has made huge amounts of money. Now FTX, being an exchange platform, has suffered from severe liquidity problems. So what exactly happened? If we go back, if we rewind the video back to January or even earlier to last year, probably go last year, let's go back to 2000 and say 17, 18, where cryptos were beginning to take off, especially being led by Bitcoin, Bitcoin being the market leader. Bitcoin has a capital, has a number of coins in circulation, around about, I think it's 22 million, I could be wrong, but I'm ready to be corrected on that by the viewers, but about 22 million coins in circulation. So it's got limited capacity, limited resource, limited amount of cryptos that can be traded with, and they began to go on an acceleration. So the crypto industry, especially Bitcoin, began to rise, and over that period of time there's more and more cryptos, more and more coins are being minted or being mined, and therefore the number of available coins became huge. I mean, there's tens of thousands of them, whether you got the doggy coins or the Shibas or the Litecoins or the Ethereums or the Bitcoins. That's just to name but a few, but there's endless. Now, as the investor or the traders poured money into Bitcoin or into cryptos, that inflated the price. Obviously things like Ethereum and Bitcoin especially, which has a limited number in circulation, the price went all the way up to, I think, 68,500 the beginning of the year. And that was highly inflated and made people very, very rich on paper. When it comes to disposing of your coins, then you've got to go to a platform. Obviously, you've got to open an account, submit all your KYC, your anti-money laundering documents, and what happens is that you can then trade or you can then transfer or pay with your particular Bitcoin or cryptos, whichever is acceptable. Bitcoin is the medium, so a lot of platforms would force you to convert your other cryptos into Bitcoin and then Bitcoin into cash. There's not many platforms that would allow you to actually convert that particular crypto besides Bitcoin into cash. You have to convert it into Bitcoin, like on Binance, and then you have to convert that Bitcoin into cash. So there was plenty of flow of money, and the plenty of flow of money came about from low interest rates, from increase in asset classes or investments or shares or the high-tech sector. So a lot of people have made money on investments over the years where that particular asset, say a share, has gone up in value and given them a lot of money, a lot of playing power in terms of cash. So that increases liquidity because there's more money floating around. It started off with the banks. The banks themselves began to print money in order to provide liquidity because there was a credit crunch or a debt crunch back in 2008, 9, 10. So the central banks in America, Europe, and the UK, Canada, Japan, Australia, they began to print money, and that was called quantitative easing. And that printing of the money is to generate liquidity, generate a flow, generate oil for the system. So we could say that liquidity is oil for the engine. Okay, so money is oil for the engine, whereby it allows the engine to run smoothly and all the parts to move without getting particularly stuck or without there being any friction between those particular parts. Now, from 2022, with the rise of inflation and other geopolitical issues, the main thrust, actually before inflation came on the scene, the central banks were already thinking about contracting or limiting liquidity. In other words, reducing their bond buying program and less stimulus within the economy. So they wanted to take oil out of the system because there was already signs of inflation from the end of last year, and the beginning of this year, the inflation began to raise its ugly head due to the stimulus packages of the banks over the 2008, 9, 10, and obviously over the pandemic period, which gave a hell of a lot of money to Joe Public and the individuals. So the banks decided to pull back a little bit by raising interest rates and cutting back on their bond buying programs, and that took money out of the economy. So say, for example, your mortgage would have cost you, say, £500 a month in January. Today, if you're remortgaging, that same mortgage would cost you around about £2,000 a month. So that's taking money out of the economy and causes a liquidity crisis in your particular home budget. So if you were to magnify that into the crypto industry and magnify that into Bitcoin or FTX, what they did is they lacked money because all of these platforms and all of these high techs and all of these startups, they're totally dependent on money being pumped into the system. And when there's no trading being done, or there's a reduction in trading, or there isn't the capital value on that particular coin generating what it did generate, therefore there is less money floating around. And if that continues long term, that's going to cause a liquidity problem. Take, for example, a company called MicroStrategy. So MicroStrategy is heavily invested in Bitcoin. I think they've got around about 53,000 Bitcoins, if I'm correct. I could be wrong, but that's just me guessing. I haven't done any research on them recently. But they're also going to have to pump in huge amounts of money to maintain their position on Bitcoin. It means they've got to take money from another source and pump it into their position on Bitcoin to maintain their position. Now, why would they have to maintain their position on Bitcoin? Because most Bitcoin trading today is done on leverage or margin. That means you only pay for a percentage of the coin, and the rest of it is effectively a loan from the platform or a loan from an asset manager, and on the hope that that particular coin will go up in value, or that particular investment will go up in value, and therefore you put down a small amount but you get exposure of the full amount. However, as the actual asset drops in value, then you're called upon to put more money in to support your position as such, because you haven't put enough money in the beginning to buy it outright. So most people don't buy a Bitcoin outright. I mean, obviously when it was 68,000, you don't get people coming along and say, I'm going to pay $68,000 for Bitcoin. What they do is they pay, say, 15,000 or 10,000 or 20% or 30% of the actual coin, and the rest of it they would take on margin. That margin is a loan where the investment provider or the asset or the platform would give you a loan that you'd pay interest on to buy the full coin. So you've only paid for part of the coin. So as that particular coin comes down, or as the crypto sector comes down, then the value of your asset reduces. So then they'd call you up and say, listen, you haven't got enough money to support your position. Send us another $10,000, another $5,000, or whatever the case may be to support your position. Now, something like Bitcoin, which is the mainstay of the crypto industry, has dropped so much that it's put a lot of companies, a lot of individuals, a lot of platforms under pressure because they don't have enough liquid money to support their positions, or the volume of business has fallen away so much they're not making enough profit or commissions on the volume of transactions. And that's what Sam Bankman-Fried betted on, is that he betted effectively on the crypto industry just going in one straight line to the stratosphere and will never come down. And he betted on the fact that it's going to be not only Bitcoin, but crypto is going to become the alternative to cash or credit cards or money in the bank, and they're going to be the main currency globally as to be used on transactions. Is probably, it could be right in 10 years, 20 years time, but at the moment that's probably premature. And that's caused FTX, which is his platform, to effectively file for bankruptcy. If you remember earlier in the week, there was a feed go out that Binance was going to buy FTX in order to support it and take it over. So what did Binance do? They sold the FTX coin, FTX token called FTT. So they got rid of FTT, they sold it in order to produce liquidity, and that caused a run on FTT, and FTT went worthless, which is the token of FTX, and that is one of the foundations of the asset classes of FTX. That effectively collapsed, which caused FTX, the platform, to collapse. Now, FTX is not the only platform globally that's collapsed this year. There's been many, many platforms have collapsed, and it looks like that the cryptocurrency industry or sector is in extreme crisis. What's likely to happen now is that there's going to be a major crypto crash regarding that particular sector because of liquidity issues, lack of money issues floating within that sector. There's also lack of money floating within equity markets. So equity markets are lacking liquidity. And one of the sectors of the equity markets is the NASDAQ and the high-tech sector. They're totally dependent on loans and investments and hedge funds putting money in, and equity partners and equity funds pumping money into the high-tech sector. And that's all dried up because if we take a typical person, let's say a typical person invested $100,000 in a high-tech startup or a high-tech company. They've lost in the last year around about 95 to 98% of their money. So the $100,000 has dropped down to around about $4,000. So you can't go back to that same investor and say, by the way, now why didn't you put in another $100,000? Because they'll be reluctant to do it, likely because they could get a better return on their money elsewhere, especially when interest rates are running now on deposits. You can get 4 to 5% on short-term deposits in the US, and probably in the UK, probably could get 3.5 to 4%. Okay, so that is reduced liquidity. That $100,000 that was available beforehand, which could have been liquidated, could have been sold and invested it elsewhere. So now that $100,000 is gone. The $96,000 has been wiped out. What does that mean? It means the value of the shares, the value of the underlying asset has dropped so much where you don't have the cash available to use. Furthermore, sometimes what investors would do, they would take their investment, say they take their Facebook shares, for example, I keep going about Facebook, or Amazon shares, and they would lodge them with the bank, and the bank would then give them a loan based on the value of those shares. Now, as those shares have fallen in value, the bank then reviews the exact arrangement and says that based on this arrangement, there's not enough money in your equity portfolio, so now you have to pay us back the loan. And what the bank has done, so say someone had a portfolio of $1 million, then they go to the bank would lend them $500,000 based on the value of their top quality portfolio. So now they've got a $500,000 loan against their portfolio of shares, which they would use to buy other investments, whether property or whether cryptos or whether other shares, etc. Now that portfolio now has dropped this year. Say it's an average portfolio, has dropped in value from $1 million down to $200,000. So the bank calls them up and says, by the way, you know the $500,000 loan you have, we need to call that in, you need to pay us back. So the investor or the borrower needs to then go to arrange the money to go and pay back the $500,000 loan, which previously was secured against the portfolio of shares. Because the shares have dropped in value, that's caused a liquidity issue. So the investor has to now go and pull out $500,000 from other investments, and therefore that's going to cause a run, it's going to cause a liquidity crisis because it's a ripple effect across the market. So that's generally to do with liquidity and the overall issue of liquidity and what is a liquidity crisis. We're going to go into a much more severe liquidity crisis in 2023, and that's going to have a big bearing, big impact on the crypto sector. So I focus most of this educational, particular YouTube video production on the crypto sector, because I was specifically asked what is the crisis within the crypto sector. So it's going to get more severe, it's going to get much tighter, and you probably could see a lot more volatility. But if you want my views, you're going to see Bitcoin down to $10,000, well, $15,000 very quickly, and then it's going to go all the way down to $10,000 as other platforms begin to fold up and more investors lose their money or pull out of the market and liquidate and capitalize on what they have. So it's going to be a major factor. This is going to continue well into 2023, and it's going to impact also on other equity markets. So I hope that was clear. If there's anything that's not really clear, you can contact me and I'll try and explain to you on a one-on-one. One of the things that I do is I do mentoring, so I can mentor individuals. Obviously there's a fee involved for mentoring individuals and helping you to be understand on an educational basis more of where we're at on a macro scale regarding financial markets. I do try to do some mainly fundamentals. I try to do some technical, but I prefer to stick to the fundamentals because most traders, most investors don't even understand the fundamentals of financial markets, and without that as a base, then it's going to be very difficult to trade. So again, you can subscribe to my YouTube channel, which is Mayor Walensky Driving Markets. I do a broadcast on a daily basis, also some educational pieces on Instagram, and I hope it's been beneficial to you. Have a good evening and catch up with you soon.